Welcome to Analyzing Finance with Nick. In today's video, I'm going to be doing a reaction to Moon's latest video, Why the U.S.A. is Collapsing, the Coming Economic Crisis. I'm going to also use this as a way to update my viewers on my thoughts that I did on the video last year, reacting to What If Alt Hists, why there's going to be a Great Depression within 3 years. It's funny because YouTube is one of the few corners where I come off as the optimist. So it's really strange in a world where I have market views that often, economic views that often be more bearish than consensus. But then when I see all the content on YouTube, it makes me look like a permabull. But with that, let's get started.
In the late 2000s, the US economy was booming. The standard of living was impeccable, the markets were booming, and the country had a reasonable inflation rate of only 3%, which meant people didn't have to worry. The economy was stable, US citizens could afford to live well, and it seemed like the US was unstoppable. But then, after a series of
That wasn't really true. The recovery in the 2000s was worse than the previous economic boom of the 90s, and it was a hollow one, created particularly by cheap financing and lax lending standards, creating a false sense of wealth effect through the housing bubble. So the halcyon days of 2004 are not really as glorious as Mr. Moon likes to point them out to be.
reckless decisions, inflation rates have skyrocketed, tripling to 9% just this year. In 2020 alone, the US government printed 40% of all US dollars in 1 year.
Okay, I talked about this in my video I did about the truth of inflation and about how this statistic is very misleading because of a variety of reasons. Mainly is the changing of the definition of what M1 and M2 are. But if you want to know more about that, watch my video about why I elaborate into this. If it was true that 40% of all US dollars in existed were printed in the last 12 months in terms of actual cumulative money supply, we would have had a lot more inflation than we did in 2021.
Yeah, and now the standard of living is dropping dramatically. More and more people are struggling to feed their families, heat their homes, and afford medical care, with the average American savings dwindling, the major banks collapsing, house prices skyrocketing.
But one thing I do agree with him on with all this is the savings rate declining is rather concerning. As you see the chart that I'm just going to show right here, the savings rate is down to 2.3%, which is only 0.2% away from the all-time low at 2.1%. Even in the 70s, when we had really high inflation, the savings rate in the United States was much higher than it is today, and it was during the peak of the housing boom. And a lot of that is just people just diving into credit cards or paying higher prices without cutting their lifestyles, even if their incomes are not going up to measure it. Either the last 6 months, you've seen personal income increase slower than personal spending, which just by basic mathematics means a decline in savings. So yeah, that's really concerning, and that is pointing towards a economic slowdown coming next year.
It's become clear to everyone that the US economy is in a deep downward spiral. There's a reason large companies like Amazon, Meta, and Google are laying off tens of thousands of their employees. National debt,
or it could be they just overhired, and that these technology companies could run their companies a lot more efficiently. Look at the example of Twitter, who's lost supposedly over half of their staff, and the website still seems to be just as operational as it used to be. I think there was disproportionately a lot more fat to cut, and the job market is healthy otherwise. I think the real risk, though, for the job market is not the fact that a lot of people are going to be permanently out of work, like what happened after 2008, but more that a lot of people who were in previously relatively overpaid, cushy jobs may have to go down to a lower paying job in the same profession or switch to a profession that doesn't pay as well. And I talk more about that in my recent interview with Chris Street. I'm going to be citing a lot of my other videos because Moon seems to be hitting a lot of fallacies that I address in other videos that I've done in the past. In this crisis so far.
When the world was in crisis, financial systems around the world turned to the US for safety. But there were still lots of problems on the horizon for the US. And the first reason that the US economy is in massive trouble is because of unsealed wounds from the Great Recession. One of the long-term effects of the Great Recession was that it gave the US massive amounts of debt, as the US government decided to bail out the...
Yeah, I talked about this. You have the double standard of, oh, if you think that all the QE and money printing was way worse than implied in the inflation data, then the debt is not as bad because that debt has been inflated away. Or if you think that QE wasn't inflationary and all this debt is bad, then you argue, wait, then money printing wasn't so bad. It's one or the other. You can't have it say, oh, on one hand, well, money printing is so bad, you've caused all this inflation. On the other hand, it's like, oh, look how high these debt levels are. They're going to have to be inflated away. Those are contradictory. And as I mentioned before, though, how central banks are able to respond to the current spike of inflation, the fact that the Fed has been able to react as fast as they have and raise rates as high as they have without causing a sovereign debt crisis shows you just really how relatively unlevered the U.S. is. And all these bank restrictions that were passed post '08, it means that the banks really aren't as dangerously overlevered as they were in '07. Like Wells Fargo is literally not allowed to grow due to judgments and regulatory actions against them. I really don't consider the U.S. banking system to be super fragile like it is in other parts of the world, such as China and the European Union.
System which had been dysfunctional in the first place, neoliberal trickle-down economics. And this led to a massive rise in inequality. Now, the US was incredibly unequal before the crash. This is just part of the capitalism, and it isn't necessarily bad. However, after the crash, this gap just kept on growing, leading to the point where the top 1,000th of the country were worth more than the bottom 90%, giving the...
Yeah, when you look at inequality data, I talk about this in my video about the Pareto principle, and I don't mean to keep repeating myself, but if you simply just did a Pareto model, you would get the same distribution as the peak income equality. The top 1% get the top half of assets. That's what you get in a standard Pareto distribution, and that's what Thomas Piketty wrote about in his book, Capital in the 21st Century. And that would have even gotten the same outcome by pure chance. And also, the reason why inequality rises when the economy is good is because asset prices rise, and those who are wealthy have assets, whereas those who are poor have debt or no assets, so they relatively fall behind. And you haven't really heard about in the news, but you know what happened a lot in 2022? You saw big declines in income inequality and wealth inequality. Why? Was it because there was some great redistributive policy that was passed? No, it was just the stock market's down, and a lot of tech valuations in the private markets are down, and a lot of bonds are down, and so therefore the asset price is down, and real estate coming to join them pretty soon. Income inequality goes down, and there's a good book on this that I will put a link in the description that goes into the history of income and wealth inequality. And usually the only things that materially change inequality are bad events such as wars, famines, and revolutions. And income inequality and wealth inequality is usually fixed not by a peaceful transition to a more fair economic outlook. It's usually just the rich people getting cut at the knees and everybody getting collectively poorer.
And the root of this problem was that people were just getting too old. People weren't having enough babies anymore.
The state of this country may be influencing a record number.
Well, yeah, the birth rates are very correlated to housing prices. When you have housing prices go up above inflation, you see birth rates go down. I've done independent studies that show there's a negative 0.45 correlation in developed nations between housing price, the cost of a 3-bedroom house in a job center metropolitan area, and the birth rate. So yeah, and that's a longer term issue. The birth rate really didn't seem to crash exponentially until about '08, and it's got to accelerate even more in 2017, 2018. And the problem is that even if you factor in that decline in the birth rate, that next generation is 10 years old or less for the most part. They're not really drivers of the global economy yet. So if you're blaming an imminent crash on the fact that there won't be a bunch of 22 and 23-year-olds 10 years from now or more, that's a faulty assumption.
With this generation now almost all in retirement, and as birth rates continue to drop, this left a lot of people to be taken care of.
Well, they're not almost all in retirement. I mean, a lot of them are retiring now, but the big problem that caused the unemployment rate that Moon is complaining about being dragged out so long during the GFC was the fact that their portfolios crashed and therefore they weren't able to retire or afford to retire, or just generational shifts, which means a lot of older people don't want to retire. And again, I talked about this in my video of Boomer Economics, the last one I did last week, if you want more details. I know I'm referring to a lot of my videos here, but it seems like I've answered a lot of the points that Moon is addressing here.
And on top of this came another layer of massive generational wealth inequality. It can be expected for people to get richer as they get older, but because the economy was shrinking over decades, the gap had been widening for some time now. Baby boomers and those older than them own 70% of the US's wealth, adding yet more decision in an already fractured country. And over time, this problem...
Yeah, I agree that is a problem, that you have just, again, because people are living longer and they are able to buy at lower valuations and were able to compound their assets for a longer time. The boomers have a disproportionate amount of the wealth, and the more concerning problem is that people my age and younger who do not have the same amount of savings or net worth that their parents did at the same age. And yeah, that is a big problem. He's right on that one.
Because despite all of America's supposedly high standard of living, the population was becoming more miserable than ever.
Yeah, but that's the economic performance and social performance are two completely different things. I did a video on this called the Great Social Depression. It is a two-part series about like why have social indicators have departed from economic performance. I think part of it is because a lot of the biggest growing tech companies' business models were reliant on making people feel sad and hate themselves or feel inadequate. And that sense of inadequacy encourages a lot of consumer spending in other parts of the economy. And so you had an economy built on social media driven insecurity for most of the 2010s. Yeah, of course. I mean, in fact, actually, honestly, there are studies to show that people who are more unhappy and emotionally insecure spend more money and take more risks. So ironically, a more miserable population would grow the economy. Yeah, and he keeps going to rants about populism and cost of living, and yeah, cost of living is an issue. I talked about inflation in my video called Compensation Theory, and if you want to know like the real economic mechanisms, I go into that. And I feel like I'm just gonna have to put all my old videos as references here. But the problem is that yeah, the government has tried to compensate for people not making real income from 2000 to 2016 by either increasing the amount of leverage that people can borrow at, or by direct transfer payments. And that is what caused the economy to keep growing even as real wages had declined from 2000 to 2016. And a lot of the growth that you see in the economy probably wasn't as high as you think it was because the inflation rates were probably higher than you think they are. It's also the one silver lining is the national debt isn't as high as people think it is because a lot of it has been inflated away. But yeah, I mean, none of his points are saying why imminent now, and why this isn't going to just be a normal recession, like a 2000 versus 2001 recession, then away again. In fact, really, if you just look at the data in terms of the level of private sector debt, the level of banking risk in the economy, they are much lower than they were in those cycles. So this just seems like a typical populist political rant more than any actual economic sound analysis on why the next recession would be worse than any other one. Overall, here are my thoughts on Moon's video. First of all, I think Moon has excellent production quality. I think it's some of the best on YouTube for video essays in terms of the graphics and the animations and all that. So A+ there. Uh, I think though what he's doing is he's conflating a populist political narrative with economic issues. Like, yeah, you can have things move against you politically, but the economy be fine. Um, it's less likely to, and I'm talking about on social issues at least. Like if you have an economy moving into like a clear socialist direction, that's eventually going to come back to bite you pretty hard. But if it's like, yeah, if the country's moving socially to the left and you have right leaning views of the world or more collectivist traditionalist views of the world, and the world gets more individualist and socially atomized, yeah, that's might not be a good thing, but it's not really going to cause an economic collapse. You're just saying, oh, there's a lot of political dissatisfaction due to certain variables, and therefore the economy is going to be in a crash. And then you're also just conflating, you're fighting last cycle's war for this cycle. And just because there was a housing bust or housing price weakness took down the economy in '08, doesn't mean one, you're going to get the same degree of of housing weakness this economic cycle, or two, even if you do, are the banks in just as levered in a precarious situation as they were back then? The answer to both is probably no. And so as a result, you're not going to get the same type of economic outcome in the next recession as you did in the last one. My expectation is probably this next recession is going, if we didn't already have one this year, and this is not going to be a double dip of a recession, that it's going to be more mild. And it'll be painful. There'll be jobs lost. There'll be slowdown in economic activity. And then the inflation is not fun for anybody. But that's not the end of the world, cataclysmic, world order destroying level economic depression like the 1930s. To say so, I think, is intellectually irresponsible. Thank you for watching. If you like this kind of content, like and subscribe.